Do you really know how much you're saving by using a commission-free broker? Robinhood seems like the perfect choice. Clean interface, no trading fees, and the promise of democratizing investing. But in practice, is it really saving you money, or just making it seem like it is? Today we're cutting through the noise. No fluff, no shiny marketing. You'll see, with real data and objective comparisons, which platform actually delivers the most value. Modern brokers like Robinhood, or traditional institutions that still charge fees but offer structure and support. If you're ready to make decisions based on logic, not hype, stick around, because this choice can directly impact your long-term profits. Over the past few years, Robinhood has become synonymous with easy access to the financial markets. The pitch was revolutionary. Invest with zero fees, all from your phone, in just a few taps. That attracted millions of new investors, especially younger ones. But while platforms like these were gaining ground, traditional brokers had to adapt, launching modern apps and more competitive plans. So here's the big question. In this new landscape, which option is truly more advantageous? Just because there's no direct commission fee doesn't mean you're not paying. The cost might be hidden in how your order is executed, in poor customer service, or in the lack of professional tools. And that's exactly what we're breaking down now, point by point. Let's start with what gets the most attention: fees. Robinhood became popular by promising zero commission. And yes, it doesn't charge traditional trading fees. But its business model relies heavily on payment for order flow, meaning it sells your trade orders to third-party firms that pay to execute them. This creates a conflict of interest. Your order may be executed less efficiently to benefit the platform. Traditional brokers do charge commissions, but those come with greater transparency. You know what you're paying, and in many cases, you get to choose the exchange or order type. In the end, paying a small fee might be a better deal than unknowingly losing pennies per share on every trade. Now, let's talk about order execution. This is a technical point, but a crucial one. Robinhood typically routes orders to market makers that pay for them. This can create slight delays or price differences in execution, known as slippage. It sounds minor, but in large trades or with volatile stocks, that detail can impact your bottom line. Traditional brokers, on the other hand, often provide more direct, transparent execution, and in many cases, smart order routing to get the best price at the moment of your trade. So while one promises free, the other gives you more control, and in the market, control means profit. Another essential area of comparison is tools and customer support. Robinhood bets on simplicity, clean interface, minimal distractions, and a focus on usability. That's great for beginners who want something straightforward. But the lack of advanced charting, technical indicators, or research tools can really limit investors looking to go beyond the basics. Traditional brokers usually offer more complete platforms, detailed charts, access to reports, market analysis, asset screeners, and most importantly, human customer support. In critical market moments, being able to speak to a real person and solve a problem can be more valuable than any fee savings. Security and reliability are also key. In March 2020, during one of the most volatile moments in recent market history, Robinhood went down for hours. Investors couldn't buy or sell. It caused real losses and serious distrust. While any broker can suffer technical issues, traditional platforms tend to have stronger infrastructure and proven track records in crisis situations. Plus, many offer added protections, like bankruptcy insurance and more robust operational guarantees. Your money's safety should come before an app's sleek design. When it comes to learning and growing as an investor, the difference is just as clear. Robinhood offers a minimalist experience, but not much in terms of built-in education. On the other hand, traditional brokers often provide learning centers with courses, webinars, market analysis, and even access to advisors. For serious investors who want to improve over time, this makes a big difference in the medium and long term. Now let's make this even clearer with a practical example. Imagine an investor with $10,000 who buys stocks on Robinhood. They don't pay a commission, but they lose around 0.3% on execution due to order routing. That's a $30 loss without even realizing it. If that kind of trade happens multiple times a year, the impact could be hundreds of dollars. Meanwhile, a traditional broker might charge $5 or $10 per trade, but offer more control, better data, and often a better execution price. When you do the math, free can end up being more expensive than it looks. So how do you decide which platform is best for you? The answer depends on your investor profile. If you trade infrequently, have a more passive style, and are just getting started, Robinhood might meet your short-term needs. But if you're more active, trading frequently, looking for analysis tools, technical support, and full control over your orders, traditional brokers make much more sense. A moderate investor seeking balance between cost and structure might even use both, one to test ideas and another to manage their core portfolio. What matters most is understanding that the best platform isn't the one that's trending. It's the one that fits your strategy and goals. To wrap it up, the big B message in this video is simple. There's no perfect broker, but there is a right platform for your style. The idea that free always wins doesn't hold up when you look at the numbers. Smart investing is about informed choices based on data, not empty convenience. If this helped you see the differences more clearly, drop a comment below and tell us which broker you use and why. Subscribe to the channel because in the next video I'll show you how to spot invisible fees, even on platforms that claim to be 100% transparent. Until then, invest with clarity, not just with style.